This is a BC Eagle accounting video. Cash to accrual income conversion for intermediate accounting, Chapter 2, Accounting Information System, Learning Objective 2.8. This video replaces the embedded video that goes along with your text. It is for the demonstration 2.8. In this case, cash to accrual basis accounting is for the Cruise Inc. company that maintains its records on the cash basis during the year, but is required to report financial statements on an accrual basis. Cruise Inc. compiles the following information on the cash basis. You have limited balance sheet accounts for accounts receivable, beginning of the year and end of the year, deferred revenue, prepaid expenses, and accrued liabilities, all for the beginning of the year and the end of the year. Also, the company tracks the cash receipts from customers as well as the cash paid for operating expenses. Again, what we want to do is to convert from the cash basis of accounting to the accrual basis of accounting. One way to do that is to make shadow entries that will do the conversion for you. 3 steps. Step number 1, revise the information given into debit and credit form. So accounts receivable and prepaid expenses will have debit balance accounts, show those as positive, and deferred revenue and accrued liabilities will have credit balance accounts, show those as negative amounts. Also, for cash receipts from customers, it will start the year at 0 and end the year at whatever amount would be reported. Likewise, for current operating expenses, they would start the year at 0 and end the year as a debit to the cash account for whatever amount that has been reported. Step 2, show the changes in the balance sheet accounts as either debit or credit changes. So, for example, for accounts receivable, it ended the year at $18,000 debit. It started the year at $5,000 debit. So to increase the account, there would need to be a $13,000 debit increase. For prepaid operating expenses, the account ended the year with $8,800 debit. It began the year with a $7,200 debit, so there needed to be a $1,600 increase debit to the prepaid operating expenses. For deferred revenue, it began the year with a $4,000 credit and moved downward to a $2,500 credit. To reduce the deferred revenue, it needs a $1,500 debit to the account. For accrued liabilities, it ended the year at $12,000 credit, began the year at $2,000 credit, so there would be a credit increase in this account of $10,000. Step 3 is to recognize that the accrued values on the income statements equals the changes in cash plus changes in, for sales, the change in accounts receivable plus or minus the change in deferred revenue. For cost of goods sold, the change in inventory plus or minus the change in accounts payable. For operating expenses, the variety of them, cash paid for operating expenses plus the changes in prepaid expenses and accruals. And finally, there is one non-cash expense, depreciation. The change in accumulated depreciation would equal the depreciation expense if there were no sales or acquisitions of plant, property, and equipment. The final step would be to put this information together in journal entries. So, for example, let's work on sales. First, we take the cash from customers. Cash would be increased by the $200,000 that's reported. Secondly, what accounts go along with sales? Let's look for accounts receivable and deferred revenue. Accounts receivable went up, debit of $13,000, and deferred revenue went down, a debit of $1,500. The balancing amount for the entry, if we would sum these three items, the $200,000 increase in cash from customers, the increase in accounts receivable, and the decrease in deferred revenue, we would have accrued sales $214,500. That is the amount that you would report on the income statement as accrued sales. For the operating expenses, we would take the cash paid for operating expenses, a credit, $100,000, put that into the entry, and then recognize that the change in prepaid expenses and the change in the accrued liabilities account will bring us to the accrued basis for operating expenses. In this exercise, the prepaid expenses went up $1,600. We will debit prepaid expenses, and accrued liabilities increased by $10,000, so we will credit accrued liabilities $10,000, and then we will have the operating expenses as the plugged figure. Credits of $110,000 less a debit of $1,600 produces operating expenses of $108,400. So there you have it. Accrued sales of $214,500 and accrued operating expenses of $108,400 would give you the beginning of the accrued income statement. This has been a BC Eagle accounting video, cash to accrual income conversion. Thank you for listening.